Dave, welcome back to Face.
Hey, good morning, gentlemen. How are you?
Good, David. David,
Mr. Keller.
I got out of a sick bed because I wanted to grill you today.
I'm honored. I'm
Oh,
honored.
are you honored? Yeah, my doctor is real happy about this. But you know what really caught my attention, Dave, and I want you to expound on it. I believe I caught a tweet that you put out there, or it was based upon one of your shows on the final bar, where you said that the market has already had enough duration for the bear market to end. Am I reading that correctly? That duration and the amount of time that we've had from the beginning of this year could be enough time for a bear market to complete. I think you were talking about duration.
Yeah, so this is where it gets kind of tricky, and it all depends on the dreaded R word, recession, right? So if it's sort of the average bear market, we're kind of there in terms of price and time. We've achieved what I think would sort of fit into the category of the average bear market phase. However, if you isolate recessionary bear markets, they tend to be deeper in longer duration in time and deeper in terms of price correction. So I've often thought about like what's the benefit of debating whether or not there's a recession, because it's a common question I get asked. And my answer as to why it makes sense is because when you look back in history and look at the times where the economic conditions really deteriorated to the point that you label it appropriately, probably as a recession, that's where the bear markets can be much more painful. And that, I think that's the biggest concern going into the first half of next year, is that does play out, which means we're probably not done, unfortunately.
Okay, so I would call that the consensus view, wouldn't you? That the lows that we had in October, which took out the July lows by a little bit, that during the first quarter or so, when earnings and growth becomes more of a concern, we're going to flush that out, trade down towards 3,100, 3,300, the pre-COVID highs, and that could complete it. It almost makes me think that the market is okay through the first part of the year as a contrarian view, that it could be okay through the spring, and that the Fed, maybe after the market thinks we have a pause, has to restart its tightening campaign because inflation really isn't going away, and then we have the big break, sell in May and go away. What do you think?
It's a really interesting point. I mean, and one of you guys mentioned, I forget, I couldn't tell who it was a little bit ago. Just mentioned, we're all in agreement. And that makes me a little bit uncomfortable, something along those lines. And I think that's true. The target I've been giving for the S&P is 3,200, which is a key Fibonacci level, and I'll show you the chart that gets you there. If you take the sort of the larger framework of the market from the March 2020 low to the January 2021 high, a couple key levels, and it's sort of these pink shaded area, the pink horizontal lines here. That first one down 38.2% was 38.15. Second one's 3,500, which is where we hit there. And I know Blake despises the 50% level, but Blake, sorry, there it is at the October low. And then if we would break that, 3,200 is the ultimate objective. And I mean, years from now, if we get down to S&P 3,200 or roundabouts and then rally from there, that will be the most beautiful use case for Fibonacci retracements I've ever seen. But what concerns me is the fact that that's very much a consensus point of view, that we are not done with the downtrend. And it's so funny behaviorally, because yesterday I'm driving into the office around like 8 a.m. Pacific time, which is when the market's just opened, and the S&P's rallying up to 4,100, getting above this big green trend line that I've had on my chart for a month or two.
You and the whole universe.
I have this whole like narrative in my head of, okay, apparently we're rallying hard into the end of the year. What does this mean? How like it's 3,200, so the objective. And then by the end of the day, we're right back below the 200-day moving average, which is 2022 in a nutshell in one day's trading, I think.
Yeah, there's probably some people stuck that went with that news up there. Do you think we work back down towards, say, 3,700, or is the pullback was mainly because people just didn't want to be long in front of the Fed? I think that's, how would you define that bar, or if you had a candle,
Yeah.
You know, what would you say about that one day? Is it a negative day? Is it a neutral day? Is it an important day where the range will give you a signal if we take out the low of yesterday or we take out the high of yesterday, we've got a signal.
So you mentioned candlestick analysis, and candlesticks are so valuable in my opinion, because when I've learned them, it tells you about the sentiment, but on a short-term basis, right? We have a lot of tools that tell us about longer-term sentiment, like money manager surveys and AAII numbers and stuff, which are more longer structural kind of things. Candle charts tell you moment to moment, how is this picture changing? And if you look at what actually happened, so this is the candle chart, and you can see my lines are still on there. Here's the big trend line coming down off of the 2022 highs. So a couple observations, right? One, when we open and then have a big, down close by the end of the day, and there's this big solid candle, a gap up and a solid candle, that shows you there was a disconnect between the catalyst that pushed the market higher at the open and the catalyst that drove the market lower during the day, right? And what candlestick analysis really reinforces is the importance of the direction open to close. And when you gap higher and close lower, that's usually not a great sign, because that tells you people were really excited about taking profits when we went up a little bit. And it's not lost on me that it's right at 4,100, which is right where we peaked out at the beginning of December. So we now have this level 4,100, which has been met with sellers a couple times now. And every time we reinforce one particular price level, that immediately becomes an important level, I think, to the market, and certainly in my analysis. So when you're looking at a day like today, which is Jesse Livermore said there's a time to go long, a time to go short, and a time to go fishing. And if there's a sit on your hands day, in my opinion, it's this one. I think this is a period. I mean, this is going to be a volatile session with a very unclear outcome. I think after today, you get a much better sense about what now to year end and the beginning of January probably looks like, because I think the tone of the Fed and particularly Powell's press conference is going to be really dissected by people and picked up on very quickly. But I'm not seeing yesterday as a big vote of confidence that we're going to get this soft landing, everything's great sort of feel. It's more of a, wow, I have a chance to get filled at 4,100, that sort of range. I have a chance to get filled on a gap higher before, this sort of craziness. And people were thrilled to take that because there's a non-zero probability that this is a painful day.
Okay. And I don't think the market can make a lot of progress on the upside with the way Apple looks to me. You want to pull up Apple, David?
Yeah. So, one of the great things about equities is you can look at you don't just look at the indexes, you can look at breadth, right? So you can measure participation. You can look at key names like Apple, Amazon, Tesla, and particularly when you think about sectors, you can usually look at a couple names and understand why that sector may or may not be in a good position. And if you look at Apple, I mean, if you bought Apple in August of 2021, you're flat for that period, which is crazy on a company like Apple, which is literally completely stalled on its upturn. So on a long-term basis, you have a stock that rallied into the new year, and that was it. And it's had a number of failed attempts to re-achieve that level and has been unable to do so. And now you're literally sort of in the middle of this range. You could call this, I'd probably call this just a consolidation pattern, a basing pattern of some sort, but you're now within what we loosely call a range within a range, right? You sort of have this broader range that we set in 2022, right? But then we have this narrower range that we set with the 200-day moving average looming very large above current levels. So this is not the type of chart that looks encouraging. This is what John Bollinger, years ago, talking with John, he would talk about the idea that volatility would often lessen before the big break, right? You have a big, a lessening of volatility, sort of an equilibrium. The market's telling you that Apple's worth about $145 a share. And it's been agreeing on that fact for the last 3 months. And we've just been trading around that equilibrium, I would argue. But at some point we break, right? And what concerns me is a stock like this breaks that pattern to the downside. And then there's real concern about the broader market.
Right. Okay. 7-8% of the market cap of S&Ps. So
and if you look at the XLY, right, or excuse me, the XLK, the technology sector, right? It's even bigger, right? You have Apple and Microsoft, which are dominating that ETF too.
Okay. And where are you with the dollar, David? you know, we've had a huge 10, 12 figure break in the Dixie,
Yeah.
and 104 was a big level that we took out. And
Yeah.
I know that you're holistic in your approach to the market and you pay attention to this. I was wondering what you were. Okay, you got a 50% Blake's hated 50% level.
Now I'm just doing this
102.11.
despite Blake. All right. I'm
All
doing
right.
this on purpose now.
Hey,
Well,
I'm
you
still
know,
listening.
all right. Well, you know what, Blake? W.D. Gann was a big proponent, but you can't argue with him because he's gone. But he
That's
was a
true.
big
That's true.
proponent of 50%. So we're approaching that. That looks pretty ugly, doesn't it? It looks so ugly, I want to buy it.
So right, so you have a very contrarian feel to your tone here today, Dale. But I hear you, and right, I think to your point, you know, do I follow the dollar and oil and gold and all this? Absolutely. And before 2022, I could accept an argument that maybe you wouldn't need to, because, and the argument I was told years ago as an equity investor was, just look at stocks and everything else is reflected in the price of stocks. But in 2022, if you had two charts, right, a chart of the US dollar and a chart of the 10-year yield, and you didn't have any charts of the S&P or anything else, you probably would have a really pretty good sense about what was happening to risk assets. You'd have a good idea about what leadership themes were, because it was a clear, you know, with strong dollar and with rising rates, that's a I think an easy lean into the value oriented parts of the market, because that's what's going to do well, and it's not going to be a growthy market. So this is one of those years where, as an equity investor, you could look at other non-equity charts and get a pretty good sense of what's going on. And the chart of the dollar tells you, I think, why and how the rally that you've seen off the October lows really happened, right? The dollar has been sort of the wrecking ball for risk assets for, you know, for most of this year. That changed a great deal. You can see what I call a change of character in the chart, right? A clear uptrend, higher highs, higher lows. The momentum in a bullish phase, and that's a Connie Brown, Andy Cardwell thing, where you're using an indicator like RSI, and you look how the whole range moves to the upper side, right? And when we pull back, the RSI doesn't get much below 40. When you rally, the RSI often becomes overbought, and that's the sign of a healthy long-term uptrend. But look at how all of that changed here in October into November. We went from being above the 50-day to below the 50-day. We went from the momentum being in that bullish range to all of a sudden breaking below 40, and now remaining in a fairly bearish phase for the last 6 weeks. Now we're breaking below the 200-day moving average. We're breaking below the first Fibonacci support. We're kind of, you know, in a bullish market, resistance levels should be met and eclipsed. And in a bearish phase, support levels should be met and fail. And that's what we're seeing with the dollar. So as a trend follower, which is more my discipline, I see this as a chart going lower. So I'm not inclined to fight this until we find some sense of stability. And until that happens, it really is telling you that there's space for equities to move higher until you get some sort of bottom here. The trend line that I would be looking at, just like the S&P is testing a trend line from the 2022 highs, you see the dollar's actually testing a trend line from mid 2021 to early 2022. That line's up just above 103. So we're actually not too far, you know, with your contrarian hat. That's a line I'd be watching. And I think there's a potential that we bottom out not too far away from current levels, which, if that would happen, I think that's a clear risk off sign for stocks.
And, you know, yesterday was a pretty classic example of the market, equities, not making hay over a weak dollar. And it's been that way for a few weeks. The dollar keeps making successive lower lows. And last week was a pretty negative week in S&Ps. I think we were down 100 handles.
Yeah.
And there was no flight to the dollar. So
No.
for some reason, the market is either because maybe the dollar's getting close to where we have a reaction, which I think is possible after a huge parabolic move to the upside. Does it just whimper and die, or does it give you one last echo rally, a hurrah, even if it's a failing rally? But I don't like the way the market really hasn't made a lot of headway with the dollar. The dollar didn't give it up like the S&Ps gave it up yesterday. And it was like that all last week. The dollar was weaker and the market was still lower. So for some reason, what should be a tailwind for the market isn't acting that way.
And there have actually, there'll been a couple of those. The other one that comes to mind is the VIX. So, right, there's this normal
Yeah.
kind of inverse relationship between stocks and volatility. So, stocks coming down usually means volatility increasing and the opposite. But you've had a number of days where, the S&P, the NASDAQ are up, the VIX is up, which, of course can happen, right? Because they're measuring two different things, and the VIX is volatility, and markets can rally on higher volatility, which is what has been happening here recently. But there have been a number of sort of kind of normal behaviors in 2022, and a lot of those have become disconnected here in the last couple of weeks, which again, that doesn't make me feel great about the sense of things going into the new year. It's not, I think the market appreciates certainty and it doesn't like uncertainty, and I'm getting a lot of uncertain vibes here.
Okay, well, the star for, we're almost into 2023, so this is the time of the year that we reflect on 2022 and then take a look ahead for 2023. The star of the show last year were oil-related issues. We've had a little bit of a pullback here. How do they look to you?
Yeah, so let me see if I can find the chart that I'd love to show you, because if you look at, here we go. So it's been really interesting, because if you look at oil and gold, for much of the last year, they've moved together beautifully. So the chart here, just so we're familiar, the dollar's at the top here, so just compressing the chart we just looked at, crude oil here in the middle, and then gold on the bottom. And we've had this scenario for, sort of the middle of the year, stronger dollar, weaker risk assets in general, and including commodities, right? Weaker oil and weaker gold with some random counter trend moves, but overall the trend was pretty consistent. And look at how much that's changed since sort of mid-October, right? You have the dollar moving lower, as we just talked about. You have crude oil coming down as well, but you have gold spiking to the upside. And what's interesting about that is there's now this divergence, and gold has not been the risk or the safe haven that I think many would have expected. Thinking of 2022, biggest surprise for me is if you told me before the year the markets were going to be struggling, equity markets should have been struggling, inflation was arguably the main reason why that was happening, I would say buy gold and just wait, and it's probably going to be a really good bet. And on a relative basis, you did okay with that bet, right? In 2022, gold outperformed stocks, but
by not being down as much.
Yeah, but it's not a feel good like, wow, I had a great year type of thing. It's just getting back to zero, right? After rallying off of the lows there. So I think there's this disconnection now where commodities aren't as much an asset class, and there's a little more dispersion between them, or a little more differentiation between them. And for me, oil now in a downturn, I think breaking below that sort of 75 level was pretty important. If we can get back above there, I think this chart can look pretty encouraging. And in the short term, you've got a trend line just taking the November and December highs, and I think getting above that would be, anytime you have a big a breakdown like that, a lot of times taking the highs there and just drawing a trend line off of those levels, and I can do it real quick, is a really good way, just a visual cue as to when that trend may be evolving. So like that would be the way to look at oil. I would be doing the same thing with gold and sort of looking at this line coming off the lows. And again, as long as we hold that line, it tells you that the trend in gold is safe. When we break that, it doesn't necessarily tell you we're going to zero, but it tells you that something's changing. And I think at this point, you have a clear, sell oil, buy gold trade that I don't know if that's necessarily done yet.
Okay. So looking ahead now, Dave, into 2023, are there any things that you're looking for that you're getting, maybe you don't have the clues yet, that you think are setting up for next year?
Yeah, I mean, I think I was asked in January of this year, what's the chart, like the chart, right? What's the chart you should have? And I didn't, it wasn't exactly this, but it was really close to this one. It was basically the 10-year. And that was probably pretty decent. I mean, the dollar may have been a little better of a call, but overall, this was pretty good. And I feel that
was.
I feel that this was a good read, and what you're looking at here is the 10-year yield, and then value over growth. So when rates go higher, value stocks tend to outperform. When rates come in, value stocks tend to underperform, or growth stocks tend to do better. And that's tracked just beautifully, right? I mean, just looking at how rates impact equity leadership. A year where, cyclical stocks are dramatically outperforming technology and communications things. We've not had one of those years in a long time, right? And so that was a very different feel to this market. I don't think that necessarily is going to stop. And I think it's the question is interest rates. And I've heard really smart people debate with me the high in the 10-year is in, or it's not that much above there. And I've heard others saying rates are going to be higher for quite some time. And that's just something we need to be familiar with. My sense would be more the latter. I mean, I don't think we've seen the high in the 10-year yet. And I think higher rates are going to be an issue we're dealing with here for not just now, but I think going into next year for sure, and probably beyond that a little bit. And what that means is it's not just a 1 year anomaly that value stocks outperform. This could be more of a structural, change where we have a period of leadership from areas like financials that we're not used to being leadership anymore. So I think, this chart is going to be a key one to look at going into next year. Obviously, we'll get, probably some sense of that today from the Fed. But I think going into the beginning of next year, that's going to be one of the most important questions is what you see in the fixed income markets. On top of that, the yield curve inversion is indicated at the bottom, just the 2s versus 10s. The longer and deeper that inversion exists, well, I've heard a lot of discussions as to why that should not be something we worry about. I've learned an inverted yield curve is usually not a great thing, and usually means that a bear market phase has a little more, is more sustained because of the recession that it usually is indicating. So I think this chart, in terms of tracking the yield curve and tracking leadership in equities, could be really interesting. What's interesting on this chart, by the way, right now is if you look. These two series, the 10-year and value versus growth, has tracked really well until the last 6 weeks. And while rates have come down, obviously, quite a bit, value stocks are not dramatically outperforming at or underperforming at the moment, right? Growth has not sort of emerged and taken over, which is what you might expect. Given that, it's sort of been a wash. And so there's this real, again, as I mentioned, uncertainty. There's sort of this choppy market in transition feel where a lot of indicators that have been really consistent in 2022 are now sort of in a pause. And I think it's all probably in some way related to the time of year, right? We're in the seasonally strongest part of the year. You have the Santa Claus rally, sort of the year-end window dressing, all tax-advantaged investing, all these things in general tend to give a bit of a boost to stocks. But January tends to be the seasonally weakest month of the year, or one of them. So we're setting up for sort of a choppy, neutral net, maybe, lightly positive December. But I think that's setting up for a painful January when we sort of come back from the holidays, wake up from the holiday hangover, and then realize that all of the challenges that we've been facing in 2022 aren't necessarily all wrapped up yet, and that there's still more to be done in the new year.
Okay, great synopsis of what we have to look forward to, more uncertainty. So anyway, I've had a lifetime of uncertainty, so I'm used to it. Right. So anyway, David, the best way for people to follow your outstanding work on stockcharts.com and be able to tune in on your programs that you do there, how do people do that?
Yeah, thanks so much. It was always a pleasure to come on and chat with you guys. I'm on Twitter at DKellerCMT, and look forward to seeing you guys there. My show is called The Final Bar. I host the Closing Bell Show on Stock Charts TV every day. Dale, you've been a fantastic guest, and hopefully in the new year we can get you back on there again. So you can go to stockcharts.com to check that out. And then my YouTube channel is called Market Misbehavior, and I post a lot of charts like this and thoughts, so you can check me out there as well.
All right, well, David should be part of your intelligence gathering from here on out. So I really appreciate, you being part of our family here, David, and I wish you and your family, we all do, a great holiday season and a great 2023, your best year ever in all ways.
I appreciate it, Dale Blake. Thanks so much for including me this year. I hope we can continue it on, and have a great holiday, okay?
All right, David Keller, everybody. And I'm going back to bed. No, I'm not yet anyway. So thank you, David, and you could join the team in 20 minutes on the Morning Edge. Good luck today, everyone, on the Fed. Don't worry about it. If you do nothing, the markets will be here. Make sure your capital is, and take what I say to heart. It's not an easy thing to do here, and you guys don't know how much I've learned from the team over the last 6 years I've been with them, I'm a much better analyst trader than I was when I first joined them. So if it could happen to an old dog like me, just think if you're early in your career, that you form good paradigms by being around people that you learn from that are better than you at this time, gives you something to shoot for. And don't just count your pips, count your blessings. Thanks for your good wishes, and we'll see everyone tomorrow. Adios. Thank you, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.